Picture this. You've just made a decision you thought through carefully, researched thoroughly, analyzed from every angle. You buy Bitcoin at $104,000. November 2024. The institutions are finally here. BlackRock launched their ETF. MicroStrategy is buying billions. Everyone is saying that this time it's different. You believe it. You really do. And now you're staring at your screen. The price is bouncing between $85,000 and $98,000. And you keep asking yourself the same question millions of people around the world are asking. We hit all-time highs. The ETFs are real. Institutional adoption is real. So why aren't we at $150,000? Why not $200,000? What am I missing? What I'm about to show you might genuinely surprise you, because the answer has nothing to do with the technology, nothing to do with regulation. It has everything to do with something far older, far more powerful, and completely legal. It has everything to do with the way large financial institutions can, without committing a single crime, apply enormous pressure on an asset and force its largest holders to sell. To understand what's happening with Bitcoin today, I need to take you to Mexico. 1982. At that time, Mexico was borrowing billions of United States dollars from international banks. The goal was noble: fund infrastructure, stimulate economic growth, build the future. But there was a problem that seemed minor at first, but would turn out to be catastrophic. That debt was denominated in United States dollars, not Mexican pesos. And why does that matter? Because Mexico does not control the United States dollar. It cannot print more of them. It can only earn them through exports, or borrow even more. Then the United States Federal Reserve decided to aggressively raise interest rates to fight inflation. The dollar strengthened, the Mexican peso collapsed, and suddenly, Mexico owed 80 billion United States dollars with no way to pay it back. The IMF stepped in with what they called a rescue package. But that rescue package came with a price. Mexico had to privatize state-owned companies, cut social spending, open its markets to foreign investors, and essentially sell pieces of its own country to pay back the banks. This pattern repeated itself in Argentina, in Brazil, in Indonesia, in dozens of countries over the following decades. It's called a debt spiral. What makes it so devastating isn't just the math, it's the psychology. When you owe money in a currency you don't control, you're not just exposed to economic pressure. You're exposed to a total loss of sovereignty. You lose control of your own assets. And now, here's the connection almost nobody makes out loud. This same mechanism doesn't just apply to countries. It applies to companies. And right now, there is a company holding more than $60 billion worth of Bitcoin. A company structured in a way that makes it potentially vulnerable to this exact trap. That company is MicroStrategy. Before we go further, let me walk you through a simple mechanic using an everyday example. Imagine you own a house worth $500,000. You take out a home equity line of credit for $100,000 at a variable interest rate. Payments are low. Everything's fine. But then rates rise. Your monthly payments double. Your income hasn't changed. You have three options: sell the house, refinance by taking on more debt, or default and let the bank take everything. And here's the psychological trap. The moment you start stressing about your payments, you start making desperate decisions. You might sell the house at a loss just to avoid default. You might refinance at terrible terms just to buy yourself time. And the entire time, the bank that lent you the money knows exactly what position you're in. The bank did not do anything illegal. They simply created a structure where your interests and theirs are fundamentally opposed. When the environment shifts, rates go up, markets fall, you are trapped. Now scale that up. Instead of a house, imagine $60 billion worth of Bitcoin. Instead of a home equity line, imagine $16 billion worth of convertible bonds and preferred shares. And instead of an ordinary homeowner, imagine a publicly traded company whose stock price directly determines whether it can keep its Bitcoin or has to sell it. That's what MicroStrategy is today. On paper, MicroStrategy is a software company. They sell business intelligence tools. But that is not really what they are anymore. What they have become is essentially a leveraged Bitcoin fund, disguised as a corporation. And the way they have structured this is both brilliant and potentially catastrophic. Here's how it works. MicroStrategy raises money in 3 ways. They sell shares on the stock market. They issue convertible bonds. And they issue preferred shares. Then they take all that money and buy Bitcoin. As of now, they hold roughly 450,000 Bitcoins. At current prices, that is worth around $45 billion. They paid about $27 billion for it. So they are sitting on an unrealized gain of $18 billion. That sounds incredible. But here is where it gets complicated. Those convertible bonds and preferred shares come with obligations. The bonds pay interest. The preferred shares pay dividends. Unlike ordinary dividends, which a company can stop paying, preferred dividends are mandatory. If you do not pay them, you are in default. Right now, MicroStrategy owes roughly $700 million per year just to service their debt and dividends. That is almost $2 million per day. Every day. No exceptions. And where does that money come from? Their software business generates maybe $100 million in free cash flow per year. That is not enough. So they have built a cash reserve of about $1.2 billion specifically to cover these obligations. At the current burn rate, that reserve will last roughly 20 months. And this is where the debt spiral becomes a real possibility. MicroStrategy's stock currently trades at what is called a premium to net asset value. Concretely, if you take the value of all their Bitcoin and subtract all their debt, you get a number. Let us call it $30 billion. But the market values the company at $50 billion. There is a $20 billion premium because investors believe MicroStrategy will keep buying more Bitcoin, and that Bitcoin will keep going up. As long as the stock trades at a premium, MicroStrategy can keep issuing shares to raise cash. They sell $1 billion worth of stock. They buy more Bitcoin. Bitcoin goes up. The stock goes up. They sell more stock. They buy more Bitcoin. It is a flywheel. It works beautifully. But what happens if the stock stops trading at a premium? What happens if the market decides it's no longer willing to pay $50 billion for a company whose assets are only worth $30 billion? What happens when the stock trades at a discount? MicroStrategy can no longer issue shares because selling stock would be like selling Bitcoin at a loss. The only buffer is that $1.2 billion cash reserve, and that reserve has an expiration date. 20 months. And if MicroStrategy starts selling Bitcoin to pay its debts, what happens to the Bitcoin price? It drops. And if Bitcoin drops, what happens to MicroStrategy's stock? It drops further. And if the stock drops further, they have to sell even more Bitcoin. That is the death spiral. Now, why would anyone want to trigger this? Why would banks or institutions try to push MicroStrategy into this situation? This is where the psychology gets genuinely dark. Imagine you are a major investment bank. You have institutional clients who want exposure to Bitcoin, pension funds, university endowments, sovereign wealth funds. These are not retail investors buying on Coinbase. These are serious institutions with strict rules about what they can invest in. These institutions cannot simply buy Bitcoin directly. It is too volatile. There are regulatory concerns, custody issues. But what if there were a way for them to buy Bitcoin at a massive discount? Not at $95,000 per Bitcoin, but at $70,000 or $75,000 per Bitcoin? This is how that could work. If MicroStrategy gets backed into a corner and has to sell its Bitcoin, it will not sell on the open market. It will do what is called a block trade. It will call a few major investment banks and say that it needs to sell $5 billion worth of Bitcoin. Who wants it? Those banks will say, sure, we will take it, but we want a discount because we are absorbing that much risk. Suddenly, those banks are acquiring billions of dollars worth of Bitcoin at 10%, 15%, even 20% below market price. Then they turn around and sell it to their institutional clients at a markup, or they hold it for themselves. But for this to work, they need MicroStrategy to actually be in distress. They need the stock to trade below net asset value. They need the cash reserve to run low. They need the pressure to build. How do you create that pressure? You short the stock. Now, I want to be very clear here. I do not have evidence of a coordinated conspiracy. I do not have recordings of bankers planning this out in some private meeting room. But I do have history. History shows us that this exact playbook has been used before. In the early 2000s, there was a financing structure called pipe deals, private investment in public equity. A specific type was called floorless convertibles. Here is how it worked. A company struggling to raise money would go to a hedge fund and say, "We need cash. Will you lend to us?" The hedge fund would say, "Sure, we will lend you $10 million, but instead of repaying us in cash, you repay us in stock." The lower your stock price goes, the more shares the lender receives. Think about that for a second. The lower the stock price, the more the lender receives. What is the financial incentive there? Push the price down. How do you push a stock price down? You short it. You spread negative rumors. You create fear. The SEC investigated hundreds of these arrangements in the early 2000s. What they found was devastating. Companies that had entered into these agreements saw their stock fall by an average of 34% within a year. 85% of those companies posted negative returns. 48% were completely delisted. Wiped out. Gone. This wasn't theory. This was reality. Real companies. Real shareholders who lost everything. And it was all perfectly legal. MicroStrategy doesn't have floorless convertibles. Their debt structure is different. But the psychological dynamic is similar. If you're a hedge fund and you believe MicroStrategy will eventually be forced to sell its Bitcoin, what's your move? You short the stock. You apply pressure. You wait. Here are some concrete numbers to show you just how real this is. In February 2025, MicroStrategy's stock fell to a point where the entire company was valued at $10 billion less than the Bitcoin it held. Think about that. You could have bought MicroStrategy shares and effectively gotten Bitcoin at an 18% discount compared to buying it directly. Why would the market do that? Because the market was pricing in the risk of the death spiral. The market was saying, yes, you own all this Bitcoin. But you've also got $16 billion in debt, and if anything goes wrong, you're going to have to start selling that Bitcoin. And when you do, everyone loses. During that same period, we saw massive short interest in MicroStrategy. Billions of dollars in short positions. Who was shorting? We don't know all the names, but we know some hedge funds publicly announced their positions. Jim Chanos, the legendary short seller, openly stated he was betting against MicroStrategy. And JP Morgan published multiple research reports stating the company was overvalued, that the structure was risky, and that if the stock fell far enough, it could be kicked out of major indexes, which would force index funds to sell, pushing the price down even further. Is that market manipulation legally speaking? No. Publishing research is protected. Short selling is a normal part of markets. But the net effect is the same. You're creating pressure on a company that is structurally vulnerable to pressure. And here's what most people don't understand about how modern financial warfare actually works. You don't need to do anything illegal. You just need to understand the incentive structures and exploit them. It's like playing poker. You don't need to cheat. You just need to know when someone is bluffing and apply pressure at exactly the right moment. Think about it from Michael Saylor's perspective. He's watching his stock get shorted into the ground. What are his options? He can keep buying more Bitcoin and hope the price recovers. He can try to raise more capital by selling shares, but that dilutes existing shareholders. He can try to pay down debt, but that means selling Bitcoin, which is precisely what he doesn't want to do. He's trapped. And the people shorting his stock know it. They're not hoping for MicroStrategy's failure just for sport. They're betting on a very specific outcome. They're betting that the pressure will eventually become unbearable. That MicroStrategy will be forced to sell its Bitcoin at the worst possible moment, which validates their thesis and makes them money. That's the dark part. This isn't Bitcoin's technology failing. This isn't a fundamental problem with the asset. This is a financial structure being weaponized against the largest Bitcoin holders on Earth to force them to sell at a discount. But what do you actually do with all this? Because I know what some of you are thinking right now. Should I sell my Bitcoin? No. And here's why. What separates a professional investor from a retail investor isn't access to information. It's the question they ask when prices fall. The retail investor sees Bitcoin go from 100,000 to 88,000 and thinks, I'm losing money. I need to sell. The professional investor sees the exact same drop and asks a completely different question. Why is this happening? And has the fundamental thesis actually changed? Professionals don't react to price movements. They try to understand the mechanics behind those movements. And if they conclude the price is being artificially suppressed through financial engineering rather than a fundamental problem with the asset, they do the opposite of what retail investors do. They buy more. This is how wealth transfers happen. Not through scams, not through fraud, through psychological pressure applied at scale. And Bitcoin is the perfect asset for this kind of play because it is already naturally volatile. When Bitcoin drops 20%, retail investors panic. But institutions look at the on-chain data, the adoption metrics, the long-term trends, and they say, this drop is noise. This is a buying opportunity. Let me tell you about something similar that happened in the gold market. In the 1990s, central banks around the world were selling their gold reserves. The Bank of England famously sold half of Britain's gold reserves at an average price of $275 per ounce. Markets called it the Brown Bottom, named after Gordon Brown, the Chancellor of the Exchequer who authorized the sales. Why sell? The official reason was that gold was a barbarous relic, that it generated no yield, that it was better to hold dollars or bonds. And here's what happened next. Over the following 20 years, gold went from $275 to over $1,900 per ounce. The Bank of England left billions of pounds in potential gains on the table. Now here is the version some people argue. Those central banks were not stupid. They were coordinating with private banks that wanted to buy gold cheap. The central bank sells, the price crashes, smart money accumulates, then the price recovers. And the original sellers look like fools while the accumulators make fortunes. Can I prove that? No. But the incentive structure is there. The mechanism is there. The historical precedent is there. Here is what that means practically. If you own Bitcoin, do not panic sell based on short-term price movements. The question is not whether Bitcoin will drop 20 or 30%. The question is whether the long-term fundamentals have changed. In my view, they have not. Watch MicroStrategy's quarterly reports closely. They publish detailed information about their cash reserves, their debt obligations, and their Bitcoin holdings. If you see the cash reserve actually starting to run dry, if you see them genuinely selling Bitcoin, that is a real signal worth paying attention to. Until then, it is speculation. Educate yourself on how financial markets actually work. People who understand debt spirals, convertible bonds, short selling, and net asset value have an enormous advantage over everyone who just stares at price charts and hopes for the best. Here's what I want you to walk away with. If institutions are trying to accumulate Bitcoin at reduced prices by pressuring distressed sellers, what does that tell you? It tells you they want Bitcoin. It tells you they believe in the long-term value. They are just trying to get it cheap. So if you are a long-term holder, the absolute worst thing you can do is panic sell during moments of manufactured pressure. That is exactly what institutions want. They want you to sell your Bitcoin to them at $85,000 so they can sell it to their clients at $150,000 2 years from now. Here is the most important thing. You do not financially engineer complex attacks against an asset you think is worthless. You ignore worthless assets. The sophistication of the structures being used against Bitcoin, the scale of the short positions, the precision of the mechanisms involved. None of that makes me less confident in Bitcoin. It makes me more confident. You do not build elaborate weapons against something that does not matter. You build elaborate weapons against something you desperately want to own, but do not want to pay full price for. So if you are feeling scared right now, or if you are worried about your positions, ask yourself one question. Do you believe in the long-term thesis? Do you believe that a scarce, decentralized digital asset has value in a world where governments are printing trillions? If yes, then short-term pressure should not change your strategy. It should represent an opportunity. If you do not believe in that thesis, if you think Bitcoin is just a speculative bubble, then you probably should not be holding it in the first place. This volatility, this pressure, this theater, it is not going away. This is the game. The only way to win is to understand the rules better than the people trying to take your money.